Mark Todd is there from FIIG Securities in Sydney, joins us now. Mark, nice to talk. Well, let's stay with the retail theme and look at Woolworths, because of course this new Tier 1 security rolled out. We're talking in the realm of just on $600 million. What does that tell you about credit markets in the round?
You know, I think they're tapping into a market that is quite buoyant. I mean, a lot of people are looking for credit assets now, so they've seen a lot of bank paper. They'll be very keen to get a corporate name like Woolworths. It'll be quite popular.
And therefore, who might be expected to follow suit? Is it going to be in that same said space, or it may even go beyond those known confines of retail in that respect?
There's clearly a drive to get more retail bonds out there, so supply and demand will mean that this will go well. I would have thought a lot of corporates with good brand names like that will look to come into the market and try and tap into a retail presence. The retail market is booming. I mean, in terms of the investor base, it's continuing to grow. We're seeing great demand for any of these assets that are around at the moment, so I don't see that changing.
Talk to me about the development of the corporate bond market. Despite undertakings, you're saying the jury's out, the government might be talking the talk, but it's not walking the walk.
I think it's an evolution that's taking place over a long period of time, that the government has identified the fact that the people that are buying the bonds have to go offshore, the people issuing the bonds have to go offshore. The only people making money are the banks and the people who are providing the foreign exchange. So the government sees that it's got to bring it back in. It had, if you can remember hark back to the days when we were going to sell Telstra, we were going to pay out the bond market and have no bond market. So that's moved quantum shift with the fact that we have an ageing population that just want consistency in income. So the volatility has meant that people like ourselves and the Challenger have seen a great drive in for fixed income assets, and the government's aware of that.
Yeah, the problem is you've got changes of government every 5 minutes. So what momentum is there for this one to cross, I guess, party lines?
I don't know that it's actually against party lines at the moment. I think there's actually a consensus of both sides of the House that they want to have a much more robust bond market. We see it from all the corporates that come and talk to us and all the banks that talk to us, that they're hearing they have a good ear in Canberra. They're saying this is the way we want to go. We just need to be careful in terms of, we don't want to create a tax structure that people can abuse, and we don't want to create a retail environment where people are advised poorly and buy the wrong assets.
Did you feel that this got enough airtime at the recent government tax forum? You talk about we don't want it to interfere significantly with the tax structures already out there, but it wasn't even really on the table from what I could hear.
You've got a 2-day forum. It's hard to get everything. I think this has been, as I said, it's been an evolution over time. They changed the way some of the disclosure rules at the last budget, so it was easier for people to issue. So you saw CBA take advantage of that, and I think that'll be an ongoing change. The CBA bond worked quite well, so we'll start to see more people coming back into that market. These are long duration assets. It doesn't have to happen on Monday. But it will happen.
You also, and longer term, by longer term, you're referring to a limit of 5 years, maybe with the potential for a return of 7%?
That's correct. I mean, I think most of the assets that we're seeing at the moment are between the 7 and 8% return for a conservative assets. You can see higher yields and lower yields. That risk is moving around. But a conservative portfolio, you should be able to get something in the vicinity of between 7 and 8% is quite a reasonable return. When you compare it to where the equity markets have gone of late, that's a great return. And
you're saying, if anything, there's a misunderstanding, a mispricing of the risk.
Oh, well, I mean, clearly, if you look at the capital structure, if I'm at a senior debt level at 6 3/4 and I'm buying equity at, the question we always ask, do you want to be the banker to the company or do you want to be the owner? And often the banker does pretty well, so I'd rather bank.
Yeah, well, that's rather a compelling proposition, as you put it that way, Mark. Thank you so much.
Take care.
Right, Mark Todd from FIIG Securities.